Welcome back. Now to our next conversation. Well, 2023 is certainly a unique year for Nigeria with the general elections just next month and macroeconomic vulnerability still not abating. In spite of all of these, the fact that more than 1/3 of the world economy is projected to go into recession, that's according to the IMF. Let's talk to Moshood Temitope, now Investment Strategy Manager at AfriInvest. Great to have you. Good morning.
Good morning, Laddie. Thank you for having me.
Great to have you. So we did get, forecast for the Nigerian economy. We did get that 3%, growth forecast, but we got a revised a downgrade, from the World Bank to about 2.9%. So do you think the Nigerian economy can beat these downbeat forecasts, and how?
All right. Thank you once again for that question. Nigeria economy is expected to grow at about 3% this year, where that's quite good on the back of so many factors that are quite unique to Nigeria, despite the fact that IMF think the world economy, like about 2/3 or 1/3 of the world economy, will go into recession this year. Nigeria is expected to deliver about 3%, but if you look at the structure of the growth, it seems the Nigerian economy is quite resilient. But then if you look at where we're coming from prior to 2016 and the 2020 economic recession, it's quite obvious that the economy is somewhat resilient. However, the resilience is not so strong. For instance, prior to 2016, the economy was growing at an average of, say, 4-5%. In fact, we saw at a point it grew by 7 to 8%. So a 3% growth looks very good. That means the fear or the synchronized fear of recessions across economies from advanced market to the emerging market, So that may look so good, but if you drill down to the structure of the growth, is somewhat disturbing. For instance, the oil sector has been in recession since 2020. In fact, last year, for the third quarter numbers, oil sector was down by more than 20%. That is quite substantial, right? And non-oil sector has been the major driver of the economy, even though that has been, the major conversation around the Nigerian economy in terms of diversification. But everyone would desire that, economy is, all sectors of the economy, is utilized or is optimized to achieve the optimum, growth. For instance, for Nigeria, if we trace back to a period where unemployment was very low. So what I mean by low unemployment, is when unemployment is lower than, say, 10%, the 9% or 8% levels. Economic growth in those periods in Nigeria, was over 6%. So that's from that, you could say that the best growth, or what we should be looking at as inclusive growth for Nigeria, is over 5, 6, or 7%. So a 3% growth, is not really inclusive, and it does not show that the Nigeria economy is so resilient. In addition to that, if you look at the structure of the economy by a sector, we have the three broad sectors: agriculture, industry, and services. And if you look at the contribution of each sector to GDP, it's very obvious again that something is happening to Nigerian economy. As a matter of fact, between 2010 to 2014, you would observe clearly that agricultural sector and industry were almost contributing about 25% respectively to GDP. But the trend has changed substantially. Industry sector is contributing less than 20%. Agric is over, agriculture sector is over 25%, and services sector is about 27%. But when you pick top economies, innovative economies, advanced economies, you will observe a unique trend. Industry is usually one of the best contributors. For instance, if you pick China, India, the US, you observe that industry contributes as much as 30-40%, followed by services. Agriculture is usually the last in terms of contribution. So that speaks to one fact, that despite the fact that it seems the Nigerian economy is resilient, the structure of the economy is not so resilient.
All right,
or I would say that the economy is not strongly resilient, maybe somewhat resilient. So it's also important to mention that, the growth we are seeing, or the growth we saw last year, is quite, that kind of growth was painful. And why I said it was a painful growth is because if you look at inflation above 20%, and output or productivity is expected to, once we have the Q4 number, we expect that growth should average around 2.9 or 3.1%. So compare, economic growth to how, inflation has surged significantly. One could say that the growth we saw in 2022 was a painful growth because it came with, high inflation.
All right,
so that's the point there.
Talking about, painful growth, from 2022, this projection now for the Nigerian economy to grow by about 3%, obviously we should be at least close to 5%. But all these numbers, all these projections, how does it affect the common man?
So, for every policy, right? For every policy, both monetary and fiscal policy, they are to focus on macroeconomic objective. Economic growth, the 3% economic growth, like I said, is just one of about 5 key macroeconomic objectives. So if we are achieving, relatively high growth of 3%, and we still have other macroeconomic objectives on the back foot. So other macroeconomic objectives include, full employment, price stability. We talk about favorable balance of payment, and we also look at, fair income distribution in terms of, income inequality. So you agree with me that currently in Nigeria, when we talk about price stability, is off the table because inflation at, over 20%, which means even if growth is 3% and inflation, because across, research outfits, even in AfriInvest, we predict that inflation will remain above 70% on average for 2023. So if inflation is still high and productivity is just about, productivity is measured by GDP, right? So if it's just going to increase by 3%, then the growth will not be felt by, by an average Nigerian. In addition to that, if the labor market is still very weak in terms of employment, nobody will feel the impact, of, the majority of Nigerians won't feel the impact of the growth. So I think we should, in addition to, the relatively high economic growth, attention should be drawn to other macro indicators that directly affect, everyone in Nigeria, which are inflation and employment.
All right. So looking at 2023, obviously we have there are some uncertainties, coming with 2023. But investors at the end of the day need to find a place to put their investment, where to put their money. So what do you say is the playbook, the optimal playbook for 2023?
So 2023, as much as for Nigeria, it comes with a lot of challenges, and it's expected to have all of that, given the general election and the policy changes that will come on the back of the result of the general election. However, opportunities abound in the financial market. For instance, this year, the US inflation is predicted to decelerate substantially. On the back of that, interest rate, is expected to follow inflationary trend, and looking at what the decision Fed will take. We also expect that to happen in Nigeria. As a matter of fact, if you look at Treasury bill rate, that started to decelerate. So what I mean by that in terms of opportunity is that let's look at the Eurobond market. We know that once yields are rising, what happened? Once yields are falling, I beg your pardon, it affects bond prices positively. So currently, we've been seeing positive momentum in the Eurobond market on the back of expectation that yield will continue to trend lower. So investors may begin to look at the Eurobond market, even though the market is highly capital intensive in terms of what is required to invest in Eurobond. However, there are also opportunities in mutual funds that are invested in Eurobond. Okay. In addition to that, it could also be positive for the equities market. That once interest rates is going down, it affects valuation positively, particularly financial sector. As a matter of fact, if you look at what happened between December and now, if you look at the Nigerian financial market, you will see major interest in the financial sector stocks, because they will benefit largely from reduction in interest rate as a result of a better margin for them in terms of interest expense. So if you look at what how that will affect the stock market, I think it's really positive for some selected stocks.
All right.
And because if you look at interest rate generally, what you get in fixed income market is getting lower. So retail investors may begin to look at opportunities in the equities market.
All right. Thank you so much, Omochi Temitokwe, Investment Strategy Manager, AfriInvest. It was great having your perspective. Thank you.
Thank you very much.